Something unusual is happening in the silver market right now, and if you're not paying attention, you might miss one of the most significant signals we've seen in years. I'm not here to tell you silver is going to make you wealthy overnight. I'm not here to make bold predictions about tomorrow's price. I'm here because the data is telling us something important, and most investors are either ignoring it or don't understand what they're looking at. Silver has always been more than just a precious metal. It sits at the intersection of industrial demand, monetary history, and investor psychology. It's both a technological necessity and a store of value. And right now, multiple forces are converging in ways that deserve your serious attention. The warning signal I'm referring to isn't just about price movement. It's about market structure. It's about the relationship between supply and demand that has fundamentally shifted. It's about the behavior of institutional investors, central banks, and governments that suggests something larger is unfolding. Over the next 25 minutes, we're going to examine what this signal actually means. We'll look at the historical context that helps us understand the present moment. We'll explore the macroeconomic forces that are reshaping this market. And most importantly, we'll discuss what rational, disciplined investors should be thinking about right now. Whether you currently hold silver or you're considering whether it deserves a place in your portfolio, this conversation is designed to give you clarity, not excitement, not fear, just clear-eyed understanding. Because in markets, understanding always beats emotion. Let's begin. When I say silver has sent a warning signal, what exactly am I talking about? Markets communicate through patterns, relationships, and structural changes. Silver is currently showing us something that has historically preceded major shifts in how capital moves through the global financial system. The first part of this signal is the divergence between paper silver and physical silver. For years, the silver price has been primarily determined by futures contracts and derivatives trading on exchanges. These are financial instruments that represent claims on silver, but most never result in actual delivery of the metal. Recently, we've seen premiums for physical silver rise significantly above the spot price. This spread tells us something important. Demand for the actual metal is outpacing what the paper market suggests. When this gap widens, it indicates stress in the system. The second component is inventory levels. Silver inventories at major exchanges have been declining while industrial demand continues to grow. Unlike gold, which is primarily monetary, silver faces genuine supply constraints because it's consumed in manufacturing. The third element involves the behavior of smart money. Central banks have been accumulating gold at record levels. While they don't typically hold silver, their gold purchases signal a broader shift in how sovereign entities view monetary metals. This creates a halo effect on silver. These three factors together create what market analysts call a structural setup. It's not about what happens tomorrow. It's about recognizing when fundamental conditions have changed in ways that alter the probability landscape. Silver has a fascinating history of boom and bust cycles. Understanding these cycles helps us avoid the mistakes of previous generations while recognizing legitimate opportunity. In the late 1970s, silver experienced one of the most dramatic bull markets in modern history. From 1977 to 1980, it surged from around $5 to over $50 per ounce. The peak was driven by a combination of high inflation, geopolitical uncertainty, and the infamous Hunt brothers' attempt to corner the market. What followed was instructive. Silver crashed back down, eventually falling below $5 again by the early 1990s. Many investors who bought near the top were devastated, but those who understood the cycle and accumulated during the quiet years of the 1990s were positioned for what came next. From 2001 to 2011, silver experienced another major bull market, rising from around $4 to nearly $50 once again. This move was driven by different factors: unprecedented monetary expansion following the 2008 financial crisis, a weak dollar, and growing industrial demand from emerging technologies. Again, a correction followed. Silver fell to around $14 by 2015. Those who chased the euphoria were hurt. Those who understood market cycles saw consolidation as a natural part of the process. Here's what these historical episodes teach us. Silver moves in long-term cycles driven by real fundamentals, but within those cycles, emotions create extreme peaks and valleys. The investors who succeed are those who understand the fundamental driver, but don't get caught up in the emotional extremes. Currently, we appear to be in the early to middle stages of a new long-term cycle. This doesn't mean straight-line gains. It means the fundamental backdrop has shifted in ways that support higher prices over time, but with volatility along the way. Let's talk about supply, because this is where silver's story becomes compelling in ways that are often misunderstood. Silver is unique among commodities. It's not abundant enough to be cheap like copper, but it's not rare enough to be treated purely as a monetary metal like gold. This middle ground creates interesting dynamics. Global silver mine production has been relatively flat for the past several years. Unlike gold, where increased prices quickly bring new supply online, silver is primarily mined as a byproduct. About 70% of silver production comes from mines where silver is secondary to lead, zinc, copper, or gold. This means silver supply doesn't respond efficiently to price signals. When silver prices rise, you can't simply open more silver mines. You'd have to increase production of the primary metals, which depends on their economics, not silver's. At the same time, above-ground inventories have been declining. The accessible stockpiles that served as a buffer during periods of deficit are shrinking. Government stockpiles that once held hundreds of millions of ounces have largely been sold off over past decades. Silver mining is also facing the same challenges as the broader extractive industry: declining ore grades, increased costs, and longer timelines from discovery to production. The easy silver has been found. New deposits tend to be lower grade or in geographically challenging locations. None of this means silver is about to disappear, but it does mean the supply curve is relatively inelastic. Supply cannot easily expand to meet growing demand, which creates the conditions for price adjustment. While supply remains constrained, demand is undergoing a fundamental transformation. Industrial demand for silver has been growing steadily, driven by technologies that didn't exist or were marginal a generation ago. Solar panels require significant amounts of silver for their photovoltaic cells. As the world pushes toward renewable energy, this demand source is expanding rapidly. Silver is essential in electronics. Every smartphone, computer, and appliance uses silver because of its superior electrical conductivity. As global electronics consumption grows, particularly in developing economies, this baseline demand continues to increase. Electric vehicles use significantly more silver than traditional vehicles. The average EV contains approximately 1 ounce of silver compared to half an ounce in conventional cars. As transportation electrifies, another demand stream accelerates. Medical applications use silver for its antimicrobial properties. From wound dressings to medical devices, this sector represents steady industrial consumption. Here's the critical point. Industrial demand is relatively inelastic. Manufacturers don't stop buying silver because the price rises 10 or 20%. Silver typically represents a small fraction of the total cost of finished products, so price increases can be absorbed. This means industrial buyers continue purchasing regardless of price volatility. On top of industrial demand, we have investment demand. This is where psychology and macroeconomics intersect. When investors lose confidence in currency, when inflation concerns rise, when geopolitical stability feels uncertain, some portion of global capital flows toward tangible assets. Silver benefits from this mindset, though it's more volatile than gold. The silver market is smaller, so relatively modest. Capital flows can create outsized price moves. Currently, we're seeing investment demand pick up after years of relative quiet. Exchange-traded products backed by physical silver have been seeing inflows. Retail interest has increased. This isn't yet euphoric, which is actually a positive sign. Early-stage accumulation tends to have more staying power than late-stage mania. No asset exists in isolation. Silver's current setup is occurring within a specific macroeconomic context that matters enormously. Central banks globally have created unprecedented amounts of money over the past 15 years. Following the 2008 crisis, and again during the pandemic response, monetary authorities expanded balance sheets to levels that would have seemed inconceivable in prior generations. This expansion has consequences. When the supply of money grows faster than the supply of real goods and services, the purchasing power of that money tends to decline. We call this inflation, though the process is more complex than the simple definition suggests. Inflation doesn't affect all assets equally. Assets whose supply is fixed or slow-growing tend to maintain or increase their purchasing power. Assets whose supply can be expanded indefinitely tend to lose purchasing power over time. Silver's supply grows slowly, perhaps 1 to 2% annually. Money supply has grown much faster. Over long periods, this differential matters greatly. Interest rates play a crucial role as well. When real interest rates, the nominal rate minus inflation, are negative, holding non-yielding assets becomes more attractive. You're not giving up meaningful yield by holding physical silver. When real rates are positive, the opportunity cost increases. Currently, real rates in many developed economies remain historically low, despite recent increases in nominal rates. This environment has historically been supportive of precious metals. Currency instability adds another layer. The global monetary system is based on fiat currencies backed by confidence rather than tangible assets. When confidence wavers, alternatives become more attractive. We're seeing signs of reduced confidence in multiple currency zones. The US dollar has served as the global reserve currency for decades, but that status isn't guaranteed permanently. Countries are gradually diversifying their reserves. Trade settlement in currencies other than dollars is increasing. These are slow-moving trends, but they point toward a more multipolar monetary system. In such a system, assets that aren't any nation's liability become more valuable. Gold and silver fall into this category. Geopolitical tensions compound these dynamics. Whether it's concerns about conflict, trade disputes, or domestic political instability, uncertainty drives some capital toward assets perceived as safe havens. Silver benefits from this, though gold typically receives more of these flows. Understanding where we are in the psychological cycle matters as much as understanding fundamentals. Market cycles move through predictable emotional stages. They begin with skepticism, when few believe a new trend has started. They progress through awareness, where more participants recognize what's happening. Then comes enthusiasm, where optimism dominates. Finally, euphoria arrives when everyone believes prices can only go higher. The best opportunities typically emerge during skepticism and early awareness. The greatest risks appear during enthusiasm and euphoria. By the time everyone is excited about an asset, the easy money has usually been made. Where are we with silver? For most of the past decade, sentiment towards silver has ranged from indifferent to skeptical. After the 2011 peak and subsequent decline, many investors wrote off silver as too volatile or unreliable. It became unfashionable. Financial media paid little attention unless prices spiked temporarily. This quiet period allowed for accumulation by those paying attention. And while the crowd ignored silver, supply deficits slowly built. Industrial demand grew. The fundamental setup improved while almost no one cared. Recently, we've seen signs of emerging awareness. More investors are asking questions. Social media discussions have increased. But we're nowhere near enthusiasm, let alone euphoria. Most retail investors still don't own silver. Most institutional portfolios have zero or minimal exposure. This positioning is actually encouraging. When an asset moves higher while most participants remain skeptical, it suggests genuine accumulation rather than speculation. The move has room to develop before emotional extremes take over. Contrast this with markets in clear euphoria. When taxi drivers are giving stock tips, when relatives who never invest are suddenly experts, when valuations reach absurd levels while everyone expects more gains, those are danger signs. Silver isn't there, not remotely. The warning signal silver is sending isn't about emotion, it's about structure. The setup is becoming clear to those who study markets seriously, but the crowd hasn't arrived. That's exactly the environment rational investors hope to find. Silver's relationship with gold provides additional insight into the current signal. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged between 40 and 60. When it moves to extremes, it often signals opportunities. In 2020, the ratio spiked above 120, meaning it took 120 ounces of silver to equal 1 ounce of gold. This was an extreme deviation suggesting silver was undervalued relative to gold, or gold was extremely elevated, or both. Since then, the ratio has compressed but remains above historical averages. This suggests silver still has room to outperform gold if the precious metal sector continues to strengthen. Why does this ratio matter? Gold and silver tend to move in the same general direction over long periods because they respond to similar macroeconomic drivers. But silver is more volatile. In bull markets for precious metals, silver typically outperforms gold on a percentage basis. In bear markets, it underperforms. If we're entering a sustained period of strength for precious metals, driven by monetary concerns, inflation, or declining confidence in fiat currencies, silver would be expected to eventually close more of the gap with gold. This doesn't mean the ratio will return to 15:1, as some enthusiasts claim, but a move toward the historical average would represent significant appreciation for silver. The relationship also tells us about market psychology. When investors first become concerned about monetary stability, they typically buy gold. It's more established, more liquid, more conservative. Silver comes later, as confidence builds, and investors become willing to take on more volatility for potentially higher returns. The fact that gold has been strong, while silver is only beginning to wake up, suggests we're in the early chapters of this story, not the final act. If you already hold silver, whether in physical form, ETFs, or mining equities, you're facing a different set of questions than someone just entering the market. Your first priority is perspective. You need to understand why you hold silver in the first place. If you purchased it as insurance against monetary instability, then short-term price fluctuations shouldn't concern you much. Insurance has value whether or not you ever file a claim. If you bought it as a speculative investment expecting quick gains, your framework needs adjustment. Silver is not a get-rich-quick asset. It's a long-cycle asset that rewards patience and punishes impatience. If you're constantly checking prices and feeling anxious about daily moves, you've positioned too aggressively for your temperament. Let's talk about position sizing. A rational precious metals allocation for most portfolios falls somewhere between 5 and 15% of total investable assets. This is enough to provide meaningful diversification and inflation protection without creating excessive concentration risk. If your silver position has grown beyond 15% due to price appreciation, consider rebalancing. I know this feels counterintuitive when something is working, But discipline means taking profits when positions become outsized, not letting winners turn into catastrophic losers when the cycle eventually turns. If your position is smaller than 5% and you have conviction in the thesis, gradual accumulation makes sense. But gradual is the key word. Don't rush to reach some target allocation in one dramatic purchase. Average and over time, taking advantage of volatility. Storage and security matter if you hold physical silver. Unlike paper assets, physical metal requires proper safekeeping. A home safe works for modest amounts. For larger holdings, allocated storage at a professional facility makes sense. Don't keep significant quantities in a bank safety deposit box. Banks can restrict access during crises, which is precisely when you most need access to physical assets. Documentation is also important. Keep records of your purchase prices, dates, and amounts. This matters for tax purposes and for your own understanding of your cost basis. It's easy to lose track over years of accumulation. Think about your exit strategy before you need one. Under what conditions would you reduce or sell your silver holdings? Having predetermined criteria helps you avoid emotional decisions during volatile periods. Maybe you'd sell if the gold to silver ratio falls below 40. Maybe you'd reduce holdings if your allocation exceeds 20%. Maybe you'd exit partially if real interest rates spike above 3%. Whatever your criteria, establishing them now, while you're calm and rational, prevents panic selling at bottoms or greedy holding through tops. Consider the tax implications of your holdings. Physical silver is typically taxed as a collectible in many jurisdictions, with higher capital gains rates than stocks or bonds. ETFs may have different treatment. Mining stocks are taxed like regular equities. Understanding the tax impact of different holding structures helps you make informed decisions. Don't neglect the rest of your portfolio. Silver holdings, no matter how compelling the thesis, shouldn't prevent you from maintaining diversification. You still need conventional assets, cash reserves, and exposure to productive enterprises. Silver is part of a complete financial strategy, not a replacement for one. Be prepared for volatility. Silver can easily drop 20 or 30% over short periods for no apparent reason. These drawdowns test your conviction. If you can't tolerate a 30% decline without losing sleep, your position is too large. Finally, stay informed but not obsessed. Following the silver market makes sense. Reading daily price predictions from internet commentators does not. Distinguish between signal and noise. Fundamental developments matter. Hourly price movements don't. If you don't currently hold silver but you're intrigued by the setup, your situation requires a different approach. Start with education. Before committing capital, understand what you're buying and why. Silver isn't a stock that generates earnings. It's not a bond that pays interest. It's an asset whose value derives from its properties, its industrial utility, its historical monetary role, and its scarcity. You're essentially betting that these properties will become more valued relative to paper currencies over your holding period. That's a reasonable bet, given current conditions, but it's not guaranteed. Nothing in markets ever is. Decide which form of silver makes sense for your situation. You have several options, each with different characteristics. Physical silver, coins or bars, offers the most direct exposure. You own the actual metal, no counterparty risk, but you face storage challenges, premiums over spot price when buying, and potential discounts when selling. Liquidity is lower than paper alternatives. Transaction costs are higher. Silver ETFs provide easy exposure without storage concerns. You can buy and sell instantly at transparent prices. But you don't own physical metal. You own shares in a fund that holds metal. There's some counterparty risk, though it's minimal with reputable funds. You pay ongoing management fees. Silver mining stocks offer leveraged exposure to silver prices. When silver rises, profitable miners see profit margins expand dramatically. But mining companies face operational risks, management risks, and political risks that have nothing to do with silver prices. Many investors have been disappointed by mining stocks that failed to perform despite rising metal prices. For most people entering this space, a combination approach makes sense. Perhaps some physical holdings for the psychological comfort of owning tangible assets, combined with ETF exposure for liquidity, and a small position in a diversified mining ETF for leverage. But start small. This is crucial. The single biggest mistake new precious metals investors make is going all in after reading compelling analysis. No matter how strong the thesis, no matter how convinced you are, your first position should be modest. Why? Because you need to experience how this asset behaves. You need to feel the volatility, watch the price action, and understand your own emotional response. Only after you've held silver through some volatility are you ready to assess whether larger positions make sense for you. A reasonable initial allocation might be 2 to 3% of your investable assets. This is enough to matter if the thesis plays out, but small enough that you won't panic if you're wrong or if volatility shakes you. Implement a dollar-cost averaging strategy. Instead of buying your full intended position at once, spread purchases over several months or even a year. This accomplishes several things. It reduces timing risk, it lets you buy more at lower prices if drawdowns occur, and it builds discipline. Ignore the temptation to wait for the perfect entry point. Investors who wait for silver to pull back often miss the move entirely because it doesn't pull back as much as they hoped. If the fundamental thesis is sound and you're planning to hold for years, entry points within a reasonable range matter less than you think. Educate yourself on the factors that drive silver prices. Follow interest rates, inflation data, dollar strength, and industrial demand trends. You don't need to become an expert, but basic literacy helps you maintain conviction during inevitable downturns. Connect with other serious investors in this space, but be cautious about where you get information. The precious metals community includes thoughtful analysts and delusional promoters in equal measure. Learn to distinguish between them. Anyone promising specific price targets is guessing. Anyone guaranteeing outcomes is selling you something. Quality analysis presents scenarios, discusses probabilities, and acknowledges uncertainty. Set realistic expectations. Silver could double over the next few years in a strong bull market. It could also go nowhere or decline. Your position size should reflect this uncertainty. You should be comfortable with either outcome. Think in the long term. Silver is not a trading vehicle for most people. Transaction costs are too high, volatility is too extreme, and timing is too difficult. If you enter this market, plan to hold for at least several years. Let the fundamental thesis play out. Consider your overall financial situation before investing. Do you have adequate emergency savings? Are high-interest debts paid off? Is your core portfolio properly diversified? Silver should be the last addition to your financial plan, not the first. Get the fundamentals right before adding alternative assets. Understand that silver will probably underperform during certain market environments. When economic growth is strong, inflation is low, and confidence is high, capital flows toward growth assets. Silver tends to struggle in these conditions. You're betting those conditions won't persist indefinitely. Both holders and potential investors grapple with timing. Is this the right moment to buy more? Should I wait for a correction? Is the move already over? The truth is that timing is nearly impossible to get right consistently. Markets don't send clear signals about exact entry and exit points. They send signals about general conditions, about probability shifts, about structural changes. The signal silver is sending now isn't buy today or miss out forever. Its conditions have shifted in ways that favor this asset over the next several years. That's a very different message. This means aggressive, all-or-nothing timing decisions aren't necessary or advisable. Gradual, disciplined accumulation during periods of structural favorability tends to work better than attempting to catch exact bottoms and tops. Think in terms of ranges rather than specific levels. Is silver in a generally reasonable accumulation range, given the fundamental backdrop? That's the relevant question. Whether you buy at $28 or $26 matters far less than whether you're building a position during the early stages of a potential multi-year cycle rather than chasing prices during late-stage euphoria. History shows that the best times to buy silver are when nobody wants it, when articles are written about how it's a terrible investment, and when years have passed without significant gains. Those conditions largely applied from 2013 to 2020. The second best time is during the early stages of renewed interest, after the fundamental setup has improved but before enthusiasm takes over. That appears to be approximately where we are now. The worst time is when everyone is talking about silver, when mainstream media is covering the story, when your neighbors are buying, when prices have already multiplied several times. We're nowhere near that stage yet. So if you're asking whether timing is right, the answer is that timing is probably reasonable, but not so urgent that you need to abandon discipline. Act with conviction, but also with caution. Build positions, but don't rush. Stay patient, but stay engaged. Let me be direct about the most common errors that destroy returns in precious metals investing. If you can avoid these mistakes, you'll be ahead of most participants in this market. The single biggest destroyer of wealth in precious metals is emotional decision-making. Silver's volatility amplifies every emotion. When prices spike, greed takes over and you want to buy more at any price. When prices drop, fear dominates and you want to sell everything. Both impulses are wrong at their extremes. The time to buy is when it feels uncomfortable, when prices have fallen and pessimism reigns. The time to consider selling is when you feel euphoric, when profits are large and everyone expects more. If you find yourself constantly checking prices, feeling anxiety about short-term moves or making frequent trading decisions, you're operating emotionally rather than strategically. Step back. Refocus on your long-term thesis. Turn off the price ticker for a while. Leverage, borrowing money to increase your position size, is catastrophic in precious metals for most investors. Yes, silver might double, but it might also drop 30% first. If you're leveraged, the drawdown could wipe you out before the eventual gains materialize. Options and futures provide leverage without explicit borrowing, but the same principle applies. These instruments expire. They can go to zero even if you're ultimately right about direction. They require precise timing, which almost nobody has. If you're tempted to leverage because your conviction is high, that's your ego talking, not your reason. High conviction should lead to patient accumulation within your means, not aggressive leverage that could destroy your financial life. Some investors become so convinced of silver's potential that they put everything into precious metals. This is irrational. No thesis is so certain that it justifies abandoning diversification. Markets are complex adaptive systems. Unexpected things happen constantly. Your analysis might be right, but still not play out as expected. Timing might be off. Unknown factors might intervene. Diversification is your protection against the limits of your knowledge. Even if silver performs brilliantly, you need exposure to other assets that prosper in different conditions. You need income-generating assets. You need some growth exposure. You need adequate cash reserves. A precious metals position that exceeds 20% of your total portfolio is almost certainly too large for most individuals. If it exceeds 30%, you're taking portfolio-level risk that's difficult to justify. When silver has a strong run and gains 20 or 30% quickly, new investors pour in. They see the gains others made and want the same. This is exactly backward. Assets that have just risen sharply are more expensive and more risky than they were before the rise. The easy gains have been made. The risk-reward ratio has deteriorated. Yet this is when emotional investors feel most compelled to buy. If you weren't willing to buy at lower prices when the setup was developing, why are you suddenly eager to buy at higher prices after the move has started? The only difference is that the former felt uncomfortable and the latter feels safe. But markets reward discomfort and punish the feeling of safety. Don't buy silver because it went up. Buy it, if at all, because the fundamental conditions justify a position at current prices, regardless of recent performance. The precious metals space attracts promoters who make absolute claims. Silver is going to $100. This is a sure thing. You can't lose. When you hear these messages, run in the opposite direction. Nobody knows the future. Markets are probability distributions, not certainties. Anyone who claims to know exactly where prices are going is either lying or delusional. Either way, they're dangerous to your financial health. Quality analysis discusses scenarios and probabilities. It acknowledges uncertainty. It presents both bullish and bearish factors. It helps you think rather than tells you what to think. If someone's message is designed to make you feel urgent, excited, or fearful, they're manipulating your emotions for their benefit, not providing you with analysis for yours. Physical silver comes with significant transaction costs. Dealer premiums when buying, discounts when selling, storage costs if using a vault, insurance if keeping metal at home. These costs compound over time and can consume a substantial portion of your returns. ETFs charge management fees annually. Mining stocks come with brokerage commissions and potential tax inefficiencies. All these costs matter. They're the friction that separates gross returns from what you actually keep. Before investing, understand the total cost structure. Factor it into your expected returns. If premiums on physical silver are running 6 to 8%, you need silver to appreciate by that amount just to break even. This doesn't mean you shouldn't invest in silver. It means you need realistic expectations and should choose the most cost-efficient structure for your situation. Silver is volatile. 30% drawdowns happen. These moves feel terrible in the moment, but volatility isn't the same as risk. Risk is permanent loss of capital. Volatility is temporary fluctuation in price. If you're holding physical silver for the long term and you don't need to sell during a drawdown, then volatility is just noise. The danger comes when you confuse the two. You experience volatility, interpret it as risk, and make emotional decisions that convert temporary price declines into permanent losses by selling at the bottom. Understand the difference. Accept volatility as the price of admission to this market. Size your position so you can weather drawdowns without panic. Then volatility becomes something you can exploit rather than something that destroys you. Precious metals have tax implications that many investors discover too late. Physical silver is often taxed as a collectible at higher rates than stocks. ETFs may distribute capital gains. Mining stocks have their own considerations. Ignoring these factors can result in unpleasant surprises when you sell. Understand the tax treatment in your jurisdiction before investing. Consider which account types make sense for holding these assets. Think about the timing of sales in relation to your overall tax situation. Tax considerations shouldn't drive your investment strategy, but they should inform your implementation. A small amount of planning can save meaningful amounts of money. The opposite error of emotional trading is paralysis. Some investors become so focused on finding the perfect moment, understanding every variable, and eliminating all uncertainty that they never actually take action. They study endlessly but never invest. They wait for absolute clarity that never comes. They let years pass, watching from the sidelines because they can't be completely sure. This is another form of emotional dysfunction. It's fear masquerading as prudence. At some point, if your analysis suggests an opportunity and you can afford to take a position within proper risk parameters, you need to act. Not recklessly, not with money you can't afford to lose, but with disciplined conviction. Excessive caution is its own form of risk, the risk of missing opportunities because you demanded impossible certainty. When precious metals enter a bubble phase, everyone seems to be buying. Your friends are buying, your relatives are buying. Social media is full of success stories. The pressure to participate becomes intense. This is precisely when the most dangerous mistakes happen. Bubbles always end badly. The people who buy during the final stage of euphoria suffer the largest losses. Have the courage to be contrarian. When everyone is buying, consider selling. When everyone is selling or ignoring something, consider buying. This doesn't mean automatically doing the opposite of the crowd, but it means thinking independently and not letting social pressure override your judgment. The crowd is right during the middle stages of a trend, but wrong at the extremes. Learn to identify which stage you're in. We've covered significant ground in our time together. Let's bring it back to what matters most, your financial well-being and your ability to navigate whatever comes next. Silver's warning signal is real. The structural conditions we discussed, supply constraints, growing demand, monetary instability, low real rates, are not speculative theories. They're observable facts that have implications for how capital will flow in coming years. But here's what I want you to remember above everything else. No asset, no matter how compelling its setup, deserves your blind faith or your financial recklessness. Silver is not a magic solution. It's one tool among many for preserving and potentially growing wealth during a specific type of economic environment. The value of understanding this signal isn't so you can bet everything on one outcome. It's so you can position yourself intelligently across a range of outcomes. It's so you're prepared if monetary conditions continue to deteriorate. It's so you're not caught completely off guard if the patterns we've discussed play out. Preparation isn't about prediction. It's about positioning yourself so you can handle multiple scenarios. Some exposure to silver might make sense as part of that positioning. How much depends on your circumstances, your temperament, and your time horizon? What matters more than your specific silver position is your overall approach to this moment in financial history. We're living through a period of extraordinary monetary experimentation. Central banks have expanded their balance sheets to levels that would have seemed insane to previous generations. Government debts have grown beyond any historical precedent during peacetime. The monetary system is under stress in ways that are not immediately visible, but are nonetheless real. In this context, some allocation to tangible assets with intrinsic value makes sense for most people. Whether that's silver, gold, real estate, productive land, or other hard assets depends on your situation. But the principle of owning things that can't be printed or easily duplicated, that principle has merit. Silver happens to offer an interesting combination of properties right now: industrial necessity, monetary history, structural supply-demand dynamics, and reasonable valuation relative to both gold and its own history. That's why we focused on it today. But don't let focus on one asset distract you from the bigger picture. The bigger picture is that you're responsible for your financial future. Not your government, not your employer, not any investment guru. You. That responsibility means educating yourself. It means thinking independently. It means acting with discipline rather than emotion. It means accepting uncertainty while still making rational decisions despite that uncertainty. The investors who thrive over long periods aren't those who perfectly time markets or find magic investments that never decline. They're those who maintain discipline, who manage risk intelligently, who avoid catastrophic mistakes, and who stay in the game long enough for good decisions to compound. If you take nothing else from this discussion, take this. Whatever you decide about silver, decide irrationally. Size positions appropriately. Maintain diversification. Think in years, not weeks. Prepare for volatility. Stay humble about your ability to predict the future. These principles sound simple, but they're profoundly difficult to maintain when markets are moving and emotions are high. That's when discipline matters most. That's when the gap appears between successful investors and unsuccessful ones. The warning signal silver is sending will either prove significant or it won't. Time will tell. But regardless of how this specific situation unfolds, the approach we've discussed, rational analysis, disciplined execution, emotional control, proper risk management, applies universally. Markets will always offer opportunities and threats. Your job isn't to capture every opportunity or avoid every threat. Your job is to position yourself intelligently, to act within your means, and to maintain the discipline that allows you to benefit from good decisions over time. Silver might be part of that positioning for you, or it might not. Either choice can be correct depending on your circumstances. What matters is that you make the choice consciously, rationally, and with clear understanding of what you're doing and why. We're entering a period where the rules that governed the past several decades may not apply going forward. That doesn't mean catastrophe is certain. It means adaptation is necessary. It means staying alert to changing conditions. It means being willing to adjust your positioning as the facts change. Stay informed, stay disciplined, stay humble, and most importantly, stay rational even when the world around you isn't. The investors who emerge from turbulent periods in the best shape aren't those who made the most aggressive bets. They're those who maintained perspective, who managed risk, who didn't let emotion override judgment, and who positioned themselves across a range of possible outcomes, rather than betting everything on one scenario. Be that investor. Whatever you decide about silver, decide it with clear eyes and calm judgment. Size it appropriately for your situation. Implement it with discipline. Monitor it rationally. And remember that it's one component of a complete financial strategy, not the entirety of that strategy. The future is uncertain. It always has been. But uncertainty isn't a reason for paralysis. It's a reason for careful, thoughtful, disciplined action. It's a reason to diversify. It's a reason to stay educated and engaged. Silver's signal is worth understanding. But your own discipline, your own judgment, and your own commitment to rational decision-making matter far more than any specific asset or market signal. Move forward with confidence, grounded in preparation, not prediction. Take appropriate action based on sound analysis, not emotion. And maintain the long-term perspective that distinguishes successful investors from the crowd that gets swept up in every wave of enthusiasm and fear. The opportunity, if there is one, belongs to those who can see clearly, act rationally, and maintain discipline over years, not days. Be patient, be prudent, be prepared. That's how you navigate markets successfully, regardless of what silver or any other asset does next. Thank you for your time and attention. Think carefully about what we've discussed. Then make your own decision based on your own circumstances and your own judgment. That's what prepared investors do.